Hi, and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau Eckstein. On this episode, we go back about 2 years ago, and I wanted to repurpose this video audio, and it's on how to search and find information about different real estate markets throughout the nation, to look at crime rate, to look at growth rate, to look at income. There's a lot of tips and tricks in this episode. So stay tuned, and we go back to the future.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
So I've got a very special guest today, and I saw this, at least I'm pretty sure it's going to be some of the same topics that I saw Neil present on in Atlanta, and it's like really, really good. I mean, I'm not an analytical guy, but this gives you like enough information where guys like me can actually figure out how to like do the basic kind of dive into like figuring out where the population's moving, and you can pinpoint it down to where the growth in that particular street is happening, which is amazing. And a lot of this data is available for free. Obviously, Neil has like a million different data sources he gets his information. Some of them are paid and stuff, but he's going to show us some free ones. He's going to show us the basics, and then he's going to kind of give us an overview of how he's actually putting it all together. I know a lot of you have seen Neil at our events, and actually Neil's a Bay Area guy, so a lot of you have attended things that he's been to, but some people that this is streaming live in the Facebook group, you haven't seen Neil. So you're in for a treat. And I'm going to have Neil kind of just give you an overview of his background, how he's so analytical, and he's such a data. I don't want to say data nerd, but a data nerd, but in a good way.
That's good. Yeah, absolutely. I'm a data nerd and proud of it. You can see my geek horns if you look close.
All right, Neil, why don't you kind of take it away and just give a little bit about your background, and then dive into your PowerPoint, and we'll go from there.
Sounds good. So first piece of information, no PowerPoint today. This is a web demo. There's going to be demos of a number of different tools. There's 3 different tools that I'm going to show you how to use today, but no PowerPoint today. You guys are actually welcome to follow along. If you have an iPad, you can actually follow along with me, because this is a workshop, a demo, but no PowerPoint. So I'm going to start off by telling you that I am not real estate royalty like a whole bunch of people that have come on Beau's show. I don't have a broker's license. I haven't flipped 100 homes or closed 1,000 loans. I'm a tech guy, like a lot of you in the San Francisco Bay Area, a techie who accidentally fell into real estate through his day job in technology. My boss asked me to build campuses starting 2003. The first one was in Fremont, and then I just kept building them in different places, Sacramento, and so on and so forth. So when I was building that campus in my day job in tech, I learned a lot about real estate, and I fell in love with real estate. And then eventually I fell head over heels in love with multifamily real estate. But as you guys probably know, real estate isn't all good, right? This is the home of false promises, the pinnacle of exaggeration. I even sometimes call it the mecca of bullshit. You know, I come from a background of engineering and data science, where data and rational thought are the very foundation of everything that we do. But what I saw in real estate was that data was really not the foundation of anything. It was lip service to investors and was used to sugarcoat tall tales and gloss over low returns. And I'm very sorry to say that I fell into that trap myself. I exaggerated. I made false promises. I shoveled some bullshit. And my investors suffered as a result of that. And so I learned the hard way that the right path was the one that I already had years and years of professional training on. And that was the hard and uncompromising path of data-driven decision making. And that path has led me to over 1,500 units or beds of multifamily and student housing. Well over 200 students are invested in my portfolio. And I welcomed 30 new investors this week. That portfolio now has over $100 million in real estate. We are definitely going to hit 200 million in 12 months. And over 4,000 students around the country use the data resource that I put together that you're going to see today. My dad used to say, if there's a God, he's in the numbers. And I believe that. And a data-driven approach can be used to improve and focus all aspects of decision making in real estate. In my multifamily boot camp, it's a 2-day boot camp that I teach. I offer over 50 data driven approaches that will make your investors loads of money. Today, in the next 45 minutes, I'm going to focus on one of those 50 approaches. That is how to pick the best cities and the best neighborhoods to invest in. I'm going to use a free public tool that everyone in this room or most people have heard of. But in 45 minutes, I'm going to open your mind to what is possible when you use the tool correctly. There will be no PowerPoint, just web demos. So let's get started. All right. The first tool is the one that every single one of you has used and continues to use every day, and that is Google. You've heard about the first rule of real estate, right? What is the first rule of real estate? Location, location, location. Well, there's a big problem with that rule because that rule just tells you location is important. It doesn't tell you how to tell good locations from bad. So here's my first rule of real estate, which actually is going to be very useful for you. The first rule of real estate is be very careful not to invest in places that are consistently losing population. Notice that I emphasize that word consistently because short population losses are fairly common in good cities. But if a city is consistently losing population, be very careful investing there. And how do you tell whether a city is losing population? Well, it's really very simple. Look at the screen. I'm going to type in population space Detroit, comma, MI. That's Michigan, right? And so Google gives me a very nice chart which shows me that from 1990 to 2016, at no point has Detroit stopped losing population. So the rate of population here was a shallow decline. Here it was a more steep decline, then a very sharp decline here, and now it's still a fairly steep decline. So every single year, Detroit continuously loses population, right? Why is it important not to invest in cities that are losing population? Because if you think about it, housing is really based on demands. It's based on two things, jobs and demand. And when population declines, there's less jobs and there's less demand for housing, which means that you might go into Detroit today and get some of the best cap rates in the US. You're getting some of the highest cap rates, 14, 15, 16, even 20. And you're thinking, oh, I nailed it. I nailed it. The cash flow is awesome. Well, two problems. And I'm going to discuss one of them later, but it's delinquency. And I'll show you why Detroit has the highest delinquency in the US. But the second problem is, if you're going to exit 10 years from now, don't you think that cap rate is going to be higher? Don't you think that that cap rate at some point when Detroit was the largest and greatest city in the US in 1960, that cap rate was probably more like 5, and now it's 15? Well, it's going in the wrong direction. And once you buy, do you think it's going to reverse and go in the right direction simply because you invested? No, it's going to keep going, which means that you might make money on cash flow, but you might not make any money at all when you exit, because when you're exiting, you might actually be selling at a lower inflation adjusted price. In dollars, you'd probably sell at a higher number, granted, but in terms of inflation adjusted prices, you might actually be selling at a lower number that you purchased. So rule number one, be very careful not to invest in places where the population is falling, right? So that by itself is maybe a little useful, but in terms of cities that are seeing population growth, right, what sort of population growth should we look for? Right? Is it a 1% population growth a year? Is it 0.5%? How do you tell what that population growth is? So let's look at the screen again, and we'll see Columbus, right? Columbus is a city that's in the Midwest, and as you know, most of the Midwest is losing population. Not so for Columbus. The other two big cities in Ohio are losing population. You see Cincinnati here in orange, and you see Cleveland in green. But you see Columbus, it is a consistent population gainer. At no point in the last 25 years has Columbus not gained population year over year. Those are the sort of things we want to look for. A nice upward graph, right? With some spikes in it. And you see a big spike here, right here, between 1999 and 2000. Columbus had a big spike in population. So you want to see some spikes, but nice upward graph. Now, what are the numbers you want to look for? There are two things I want you to see. I want you to mouse over until you hit the year 2000, and I want you to note the population of Columbus. So it's about 715,000. And then I want you to go all the way to 2016, and I want to note it again. It's 860,000. So the difference between these two numbers, ideally you want to invest in cities where the difference between the 2000 number and the 2016 number is roughly 20%. So you want to see a 20% growth from here to here. And in Columbus cases, it's almost exactly a 20% growth. The reason I use Columbus for my examples is it just matches all of the metrics that I use. But there's a number of examples, like Orlando is going to be a little bit higher or lower than those metrics. But overall, you'll see that most cities in the US make sense with these metrics. So 20% growth. But you might say, wait a minute, Neil, don't smaller cities grow faster? And don't larger cities like LA grow slower? Yes. So the answer is, if the city is over 1 million people, then you can discount its growth and say, well, it doesn't need to grow faster than 15% over that same time frame. So 20% if it's 500,000 to 1 million people, which is a lot of our cities, 15% if it's above, and then 30% if it's below 500,000, because cities below 500,000 tend to grow very fast. Why do they grow faster? Because there's less red tape. Red tape is what slows growth down. So as cities get bigger, they slow down. So cities smaller than half a million, you want to look ideally for 30% growth. But the most common number that you look at is 20% growth, because a lot of the cities you're going to target are going to be in that 500,000 to 1 million range. Now keep in mind, this isn't Columbus Metro. It is Columbus City. So these numbers apply for cities, not necessarily for metros, because Columbus Metro probably has 2 million people. You don't want to look at that 15% number. You want to look at the 20% number, because you're looking at Columbus City, not Columbus Metro. All right. So population is the key factor, the first X factor. Once again, you want 20% population growth. Now that you've moved past the population, so if you've looked at some cities and you looked at maybe a dozen of them, and you're like, oh, okay, these are all growing at roughly 20% over this time frame. Well, which one of these do I pick beyond the population? Well, for that, let's switch to our second tool. Google was our first tool. We're going to go to our second tool.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
And our second tool is going to be, and I have St. Louis, let me go here, is a tool called city-data.com. So city-data.com is the name of the tool. And so you go in there and you type in the city, and I'm going to type in once again Columbus, Ohio. And by the way, this works for all cities, right? You could type in Fairfield, California, Vacaville, California. You could type in even cities as small as Suisun City, California. And the data is there for all of those cities. So it's very powerful. So I'm going to keep scrolling until you see the median household income. Do you see this? Estimated median household income in 2016, right? So this is the second number. We talked about population. Here's the second important number that you want to look at when you're figuring out cities for investment. And that number is estimated median household income. Ideally, you want to see this number, 37,000, and you want to compare it with this number. And you want there to be about a 30% growth. Remember, population was 20%? In income, we want to see a 30% growth in income. So that 20% population growth pushed the median household income. Because remember, when population increases, it creates jobs. When jobs happen, it creates job inflation or wage inflation. So a 20% boost there is giving us a 30% boost. And Columbus, once again, almost matches perfectly, because if I add about 30% to 37,000, I'm roughly going to end up at 49,000. So once again, Columbus meets our criteria. Yay, it's a good city to invest in from the perspective of median household income. And now let's look at the third number when it comes to looking at cities. Right below it is median house or condo value. Now, so what's happened so far? The population grew, and that population growth created jobs. And that growth of jobs created wage inflation, which created increase in household income. Well, that increase in household income now drove up the demands for home, which is why the last number is 40%. Between 2000 and 2016, I want this number, this 100,000 or 99,000 to go up 40%. And once again, Columbus is a great example because it's roughly up 41% in that time frame. 41% of growth in Columbus. So the 20, 30, 40 rule worked really, really well for Columbus. Now, for most cities, it's going to be a little uneven, right? They might not exactly get there on income, but they got there on median household value. And if that's happened, that's fine. You don't have to have all of the rules match perfectly. But you'll notice that for good cities, strong growth cities with lots of jobs, you'll see that they'll jump through all three of these hoops and be just fine. There is a fourth hoop to jump through, and that is crime. So I'm going to scroll down lower on the page. So I'm going to keep scrolling until I hit a big blue table. There it is, big blue table. Come on. There it is. And so this table shows crimes, and it's got all the different categories of crimes, the murders, the rapes, the robberies, the assaults. And for our purposes, we're just going to skip all of those and go to the blue line at the end. Do you see this blue line? Okay, here's your fourth rule of thumb, and it's a slightly complex one. The fourth rule of thumb is you want the number on the left to be much higher than the number on the right. See, this number is 414, this number is 757. What that means is crime was very high in Columbus, but gradually over time, the city has gotten control of crime, and that crime has continued to decrease. And what I like is it's a very clean decrease, right? So it's not bumpy, it's not really up and down, it's very clean, consistent decrease. And now crime is below the magic number of 500. So what's the crime number? You want a city to be under 500, and Columbus meets that benchmark. It comes in at 414. So it meets the 500 benchmark, but then it also meets the other benchmark, which is a decline in crime. From 757 to 414 is an incredibly large decline in crime. So kudos to the City of Columbus Police Department. They definitely know what the heck they're doing. So that's our 4 metrics for cities. And if you're applying these 4 metrics, I can tell you right now, you're going to buy better than 90 to 95% of every investor out there in the US. So you're already in the elite, you're in the top 10%, but you're not in the top 1% because so far you're just good at selecting cities. How do you get to the top 1%? Well, by selecting neighborhoods, because neighborhoods matter more. Every great city has horrible areas. Orlando, Phoenix, all of these cities have really ghetto areas that you never want to buy anything in, extremely crime-ridden areas. And so it's very important to really understand the neighborhoods. And that is what we're going to do next. I'm going to scroll back up until we get to this area that looks like a map. Do you see this? This is a map with gradations in it. I'm going to open this all the way. Now, the red lines are the City of Columbus, the city limit lines. Keep in mind that the method that I'm about to show you to pick neighborhoods only works inside a city limits. Do not go outside city limits to apply it. Why? Because you start running into farm areas, and one rich farmer can throw off all the numbers because there are very few people living in those areas. Do you see how big the areas are outside the city? You do not want to be messing with outside the city. So the first thing I want you to do in case you're following along on an iPad or a laptop is I want you to drag this opacity over to and make it 100, because that's going to make it much easier for you to see things, right? Right now you can see the dark blues and the light blues much easier. We're going to go back and change it the other way later on when we want to figure out the underlying streets and roads under this map. All right, so what am I looking at, right? I'm looking at all these gradations of blue color. And what do these really mean? They mean income levels. You look at this drop down at the top. This is the median household income in the city of Columbus. And this is the most recent value. If I click on this button, it's actually going to show me the change since 2000. But right now it's showing me the most recent value. So I think it's fairly reasonable to say that this is the richer part of the city right here, right? So you see this part here, very, fairly rich, fairly affluent because it's dark. And then there's another rich portion of the city right here. So this little odd shaped portion is fairly well off. But the rest of the city is not doing well. There's a lot of portions in Columbus, like most Midwest cities, that are very, very low income. And I'm going to show you the difference. It's very stark, right? So first we're going to pick the richest portion of the city. So this portion right here, if I click on it, it's going to show me And Bo, can you give me a thumbs up to make sure that this box is visible on the right, on the screen? The
Yep. Yep.
230,000.
You're good.
Perfect. So now you can see just how amazingly rich this portion of the city is. The median income, that's half the people above, half the people below, is 230,000. That's San Francisco Bay Area levels. And as you can see, as a result of that, almost nobody lives below a poverty level. Unemployment is practically zero. Remember, when we reach 3% unemployment, that is actually zero, because the last 3% of the people don't want to work. They do not want to be employed. And so 3% is effectively zero unemployment, and this area is at zero unemployment. And you can see median household or condo value well over 600,000. Now you might say, oh, I really want to invest in this area, Neil. No, you don't, because in an area like this, you definitely are not going to get any cash flow. This is no different from investing in the San Francisco Bay Area. San Francisco is the most phenomenal market in the US. The Bay Area is the best market in the US for fix and flips. The Bay Area is not the best market in the US, not by a very long shot, for rental property. So if you're looking to buy and hold, this may be not the right place. But if you're looking to fix and flip in the city of Columbus, it's exactly the right place. This is where you want to fix and flip. Or maybe if you're brave enough to do new construction, sure, you might want to do that over here as well. So what do we do, right? So this doesn't work for us. Well, then we start looking at where else in the city can we go that we can target. Now, before we look at some of the nicer areas in the city that we can go, let me show you an extreme example of, this city. Do you see this portion on the right in yellow? I just clicked on it. Now look at the income. Median household income has gone from 230,000 in my first example to 6,000. How is it possible for any area in any city to have a value of 6,000? The short answer is because it's abandoned. This area is abandoned. It is a dilapidated area that has now been abandoned. They're going to have a bunch of homes and warehouses and things like that, but nobody really lives here anymore, which is what drives this value down. And you can see the big reason for that. Residents below poverty level, 85%. So as you can imagine, this white area is primarily for homeless people. So very, very few people actually are live in a house, and if they're living in a house, they're certainly not paying rent for it. They're just squatting. And so clearly not an area for you to invest in. So be very careful to invest in these kinds of areas, because if they're not war zones, they could turn into one by tomorrow morning. So now I'm going to go back to my dark blue area and start clicking close to that area. So I'm going to click on this one and say, how's that? Well, 93,000, better, a little bit closer to, to where I want to be overall, but still a little bit on the higher side. So let's click on another one. And that's 121,000. I'm going to close that one, maybe pick this one. 94,000. So this cluster is a little bit too rich for what I want to do. So I'm going to go a little bit across the road. Now here's something very, very interesting. Haven't you heard that real estate is hyper local? It's extremely local. This gives you a perfect example. Let me zoom in so you see how close these areas are. So I'm going to zoom in here, right? And so you notice that this area, when I clicked on it, it was roughly, oops, let's go up a little bit. It was roughly $93,000 in income, right? 93 grand in income. Now, so this was this area. Now you notice this is probably going to be a street, a road, or maybe a railway line. The moment I went on the other side, income decreased drastically. It decreased drastically and went from $93,000 to $26,000. That's how hyper local real estate is. When realtors who've been working for 20 or 30 years say things to you like, I know which side of the tracks, I know which side of the road, this is what they're talking about. And now you know it, and you actually know it better than that agent that has been working here for 30 years. You actually know all of the best areas that he should be looking at because you understand it. So let's zoom in and click on some of these areas and see if they're the right areas for us to invest. So $32,000 in income, we're getting there. How about this one here? 48,000, there we go. All right, I gave you 4 rules for cities. Here are my rules for neighborhood. When you're looking for neighborhoods, you want the median household income to be between 40,000 and 70,000. 40,000 on the lower end, 70,000 on the higher end. And this area meets that particular requirement. Oops, That's my yoga alarm, Beau. I got to run over and get rid of that sucker. See? No yoga because of you, Beau. Alrighty. Okay, back to the presentation. So 48,000 is right in the middle of that sweet spot. Now, why is it important not to look beyond 70? Well, that's actually a soft limit. You can go as far beyond as you like. You can go to 80 or 90 or 100. But as you go higher in median household income, you're going to see a decline in cash flow, right? So if you're like me, I'm a very conservative guy. I'm Indian, so by nature conservative. I'm probably living in that 70 to 80,000 dollar range, and I don't mind the cash flow being low, but I want higher quality. So if that's your focus, if you don't want max cash flow, you can live in that 70 to 80 or even 70 to 85K range. But by the time you're over 85K, really whatever cash flow is there is gone. So if you're looking for cash flow, if that's your goal, and a lot of the people that are buying these kinds of turnkey homes are looking for cash flow, 40 to 70,000 is your sweet spot. You can go a little bit lower than 40,000 in the Midwest, but don't go much below that because it's the bottom limit that really is challenging. Now, take a look at how much of a difference this made. Do you remember that portion that I showed you over on the far right that had $6,000 in income? Well, that particular area, right? The residents below poverty level were 88%, and now we're at 18. So let me give you my second rule of neighborhoods. You want to stay away from areas where the poverty level is above 10%. Okay? Now, if everything else looks good, I'll consider a poverty level between 10 and 20%. So it's not a hard 10%, but the higher you get, the more delinquency you're going to see, because people who are below the poverty level cannot cut you 12 checks in a year. You'll be lucky if you get 10. And so if a very significant portion of the people that are living in that area are below the poverty level, then you're going to have a lot of trouble collecting your rents. You're also probably going to have trouble with unemployment, though that's not the case in this particular area. So we're going to keep clicking, right? We're going to go click on this one, see what comes up. So that's actually the $26,000 one that we looked at. And I'm going to go a little further here, click on this. There we go. That's a very nice area. Very, very nice area. I like this one. So unemployment, 1.82%. So I really like that. So obviously this area is doing really, really well. Median contract rents are in line. So here's my next rule. The next rule of neighborhoods. Go into areas where the median contract rent is between 700 and 1100. Once you're above 1100, again, you'll have cash flow issues. You can keep going if you like. But 700 to 1100 is the sweet spot for rents. Below 700, once again, you're going into an area where people really don't have the ability to pay. And you're going to suffer because of that, because your delinquency costs, your churn, and your eviction costs are going to be very high. So median contract rent, 700 to 1100. Unemployment, so here's the last rule of neighborhood. You do not want the unemployment to be more than 2% higher than the city. How do you find out the city's unemployment rate? Well, just go to Google and type in unemployment rate Columbus, Ohio. And the first link that you'll get will show you that the city of Columbus today is at 3.4%. So what that means is, going back to that page that we were just at, you do not want this unemployment number in this area that you're targeting to be above 5.4. If Columbus is 3.4, you want to be at 5.4 or below. And you might say, well, Neil, why shouldn't we be below 3.4? Well, the short answer is because the A areas and the B areas are always going to be below. And if you're cash flowing, most of the time you're buying C property, right? You might buy Bs, in which case go for, match Columbus's unemployment rate. But if you're buying C properties, which is fairly common with people that are doing either, flips and fixing them or doing buy and holds for cash flow, so you are buying at the lower end of the spectrum. So you can go a couple percentage above. And you'll notice that as I keep clicking through the city, I'm going to come across some interesting examples of what is possible in terms of unemployment. Did you notice this area is at 20% unemployment? It is no more than 2 miles away, maybe even a mile and a half from the area that I just clicked. That area was at 3.8% unemployment. This is at 20%. That's how hyper-local certain cities are. And certain cities, by the way, are more hyper-local than others. So a very good example of a city that's hyper-local is Memphis, right? High crime cities tend to be hyper-local. So Memphis is a high crime city. As a result, Memphis is a city where a Class A and a Class D can be next to each other, right? You've heard of Class Cs, right? What's a D? Well, D is one of those places, as you go past it, you might find that an extra piece of lead is lodged in your shoulder all of a sudden, or somewhere besides your shoulder, if you know what I mean, simply because you're walking past it. And in Memphis, A's and D's can actually coexist on the same street. So Columbus is not as hyper local as Memphis, but it is fairly local. You notice that as I move from one area to another, the numbers change a great deal. They change quite a bit. So this one's 57,000, and here unemployment was 3.5%. And this piece of yellow, area was roughly 200 or 300 yards away from this other area that I showed you with the 20% unemployment. See, right here, look at the difference. So it is fairly local. And by the way, as you notice, once you start hitting these areas with low incomes, like $15,000 in income, you start seeing poverty levels that are absolutely unacceptable for rentals. 30% poverty level mean you will never make a dollar on your property because your churn rate, your turnover costs are going to be staggeringly high. So don't even go there, and don't say, oh no, I'm getting a really good deal. You're not getting a really good deal. You're getting a really cheap deal, which is cheap because nobody else wants it. Nobody in the city of Columbus wants it. And there's lots of rich people here. I just showed you some of them. They know about these areas. They don't want to touch anything there. So be careful. All right, so those were all of your rules. I gave you 4 rules for cities and 4 rules for neighborhoods. And these by themselves make you kind of in the top echelon of investors. You can now find amazing, amazing deals in all sorts of cities in the US. The one last piece I want to show you is this. I'm going to zoom out just a little bit. So this is a more advanced approach. Remember there was this button here that said percentage change since 2K? If I click that button, it's going to show me the path of progress in the city. And notice that now everything is a little bit darker. Why? Because thanks to inflation, the median household income in every area in the city, except for this one little area here at the bottom, has gone up. But that's just because of inflation, right? You certainly want to focus on the areas where the income is increasing the most. So if you want to ever know a definition of what is known as the path of progress, people talk about path of progress all the time. For the first time, in front of you is the real path of progress. I'm going to mark it out for you. Here it is. This is the path of progress in the city of Columbus. And it's kind of flowing in this direction. And also it flows up here along between this road here on the left and this road here on the right. This is the path of progress in Columbus. Now, you do not want to invest in areas that are not in the path of progress, especially if that is a city that's alien to you. Obviously, a lot of you are from California. You don't know this area. So I wouldn't invest in this middle area. But I would definitely consider investing in this area. In fact, whatever these 2 roads are, this road on the left and the road on the right, if these roads keep going here, then I would think about investing here because the path of progress seems to be bounded by these 2 roads. So keep looking at these kinds of things when you're making your investments, and you'll do really, 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 really well. So now, how do you know where in the city I am? This is the last part of my presentation when it comes to city data. Where am I? Remember that opacity button that I dragged over? So let's say you like this area. You see this area? It's really dark, right? Which means that income is really growing here. So the first thing I'm going to do is I'm going to zoom into this area. So I'm going to zoom in as much as I can. Zoom in. There we go. I'm going to bring it to the center again. I'm going to zoom in one more time. There. Now I'm going to go up to that opacity, and I'm going to drag it to the other side because I've already selected the areas that I want to invest in. And now I can see the areas. Now I can start taking screenshots. And you can actually, if you zoom in a little bit more, you can actually see the names of these roads. And you can see that the path of progress flows on the bottom of this particular road, but not above it. That is why real estate is hyper local. So I definitely don't want to invest in this area, but I don't mind investing in this north inner belt area, and I certainly don't mind investing in Fort Hayes. I like the Arena District. I like Grandview Heights, but I don't like the areas above here simply because the numbers don't seem to make sense in those areas. So that's you becoming an expert in the arena of cities and neighborhoods. I'm going to give you one last tip, and that is for people that want to buy and hold for 10 years or longer. But before you do that, I'm going to point something out to those people that are interested in multifamily investing. Here's a fact for you. Multifamily has proven to be one of the best asset classes for long-term wealth accumulation. Not necessarily get rich quick, but get rich slow, but get rich sure. And that is why I teach a boot camp. I call it the last honest apartment boot camp in America. And it makes you 3 unique promises. And the first promise is the training is very eye-opening, it's very specific, it's very tangible. And if you look on the right, you see all these reviews from people. They're talking about the fact that they've seen all these specific tools that they've never seen anywhere, tools that they can begin putting into practice right away. My training is also pitch free. In fact, you're now listening to the pitch for my training. There is no upsell. There's no coaching, no mentoring, no tapes. There is no second level of buying. When you come in and take the bootcamp, you will get 12 hours of concentrated learning and 0 seconds of pitch. I promise you that. And here's the proof. The multifamily bootcamp was 100% sales feed training, lots of content, resource, and tips you can use right away, and no sales pitch, all training. And the last promise is it's filled with shortcuts and secrets and strategies that you've never seen before. Everything that I showed you in the last 40 minutes, every single thing I invented myself. I'm a data scientist, and I applied that data science to CD-data and came up with it myself. I haven't picked it up from a book. I haven't picked it up from Bigger Pockets. It's invented here. You saw one of my 50 plus different strategies that are unique. Here's Isosa. He's taken 5 different boot camps, including a $40,000 one, and look at his comments. Isosa actually believes that my boot camp was the best he's ever attended, and he's attended Dave Lindahl's $40,000 boot camp. So if you're interested, the multifamily boot camp, and I'm going to skip past these, is going to basically teach you everything you need to know about buying multifamilies with other people's money. That is what you're going to learn. Everything that you need to buy other people boot camps with other people's money. If you're interested, go to multifamilyu.com. That's multifamilyu.com. This code doesn't work anymore, guys. The code is THRIVE, THRIVE. Boy, it's hard to write with a mouse. How about this? Let me try this. Oh, that works. There we go. THRIVE. So that's the code that gets you $300 off. After the code gets, knocks $300 off, it's $1,000. It's meant to be incredible value for money. You're going to be with me 2 weeks in the evenings, 5:30 to 7:30 Pacific, live. I'm going to be teaching you just like I teach now, with one exception. I have a second monitor, and as students type in questions, I answer them. So I don't wait until the end. I answered 600 questions in my last boot camp. So continuously answering questions. Every session is live and recorded and is available for playback for you the next day in case you miss one. Most importantly, my action plan is index linked to those recorded sessions. So 90 days later, if you're buying a multifamily and you want to know how to pick a property manager, you go into your action plan, scroll down to the property management section, and it tells you which video to watch, how many minutes to watch, and all of a sudden you're an expert on picking property managers. So check it out. Multifamilyu.com has huge number of free resources as well. And now I'm going to give you your last tip of the day. So there's this website that I really, really love, and it is called weareapartments.org. Now, this is an apartment website, but actually works for anybody that is interested in long-term growth, right? So you want to know what cities have the best long-term growth? Well, I can tell you that if you click on the metros on weareapartments.org, that's with an S.org, you can look at every city in the US. These are all the big cities in the US, and it'll tell you what the demand is for the next 13 years. Why is this important? Because a recession is coming. We all know a recession is coming. We all know that it might last a year. And so it's important to understand which cities are going to weather that recession well because they have long-term demand. Here's a city that may not do well. Okay, it's Pittsburgh. Not a bad city at all. But as you can see, the demand for apartment household growth or rental growth and the population growth are really up and down. So right now seems to be a peak, and that's why you're hearing good things about Pittsburgh, but the population is projected to fall and then just kind of goes up and down. As a result, its supply and demand curves are not impressive. So you see this red line here, that is the projected supply line of incoming apartments. And you see this light pink shaded section, that is the demand. And I don't like the fact that many of the years the demand is actually lower than supply, and it very rarely ever gets higher than supply, which is why I certainly will not be investing in Pittsburgh, especially not for the long term, where the demand is going to be substantially below supply. That can't be good for rents, especially because you've got lots of other awesome options in the US like Phoenix. Here's a look at Phoenix. Look at how nice the supply curve is. Population growth straight up. Apartment household growth straight up. And when we look at the new construction, this is the supply and this is the demand. Is it fair to say that at no point in Phoenix is the supply matching demand? And if supply isn't matching demand, it's a good place for buy and hold. It's a good place for fix and flip. It's a good place to move to if you don't like the San Francisco Bay Area. So these are the sort of trends that you want to look at. Here's another metro that's a favorite of mine. Atlanta. The supply demand gap is even higher in Atlanta. So that's another place to look at when you're looking to invest. And of course, you know, a lot of you are Californians. There's a bunch of Californian cities in here. So you get some very interesting insights when you start looking at Californian cities. The reason I didn't pick California, even though many of you are Californian, is you're going to do that anyway. I wanted to highlight the rest of the US to you because you're going to be filtering and picking Californian cities as you go through this list. San Jose, for example, here you go. So San Jose, not very interesting in the long run, right? Because why? Because San Jose has a lot of new construction projects. There's the supply is quite significant. This doesn't mean San Jose is not a good city to invest in. For fix and flip, it is considered to be the #1 city in the US. But if you're doing apartments, if you're doing long-term rentals, the city is doing well in taking care of its needs. So supply is going up together with demand. Keep in mind, this is weareapartments.org, not wearesinglefamily.org. So they are showing you apartment data, but a lot of it does apply to single families. So hopefully you enjoyed that particular link. And now if you want to continue the learning journey, everything that I've taught you plus about 100 times this is stored at a link. And here's that link. I'm going to give you the link. Oops, let me see if I can find it. There it is. So I have a toolkit. It is called the Real Estate Trends Toolkit. And in the toolkit, I put together my trends presentation, which is a shootout of the top 80 cities in the US. As you can imagine, a dozen of those cities, maybe even more, 15 of those cities are California. And so it really ranks those cities, right? So top 10 shootout results for fix and flip, for appreciation, and for rental growth. So that presentation is in here. The PowerPoint deck is in here for those that are lazy and want to go through it very quickly. But more than that are my videos. So trends videos about mass migration from California, about mortgage rates and their impact on the market, how long can the market stay strong. All of those videos are in there. And then my articles are in there. For people in California, the affordability crisis, people will enjoy reading about this. The tax reform and its impact on California is significant, so read that particular document. And for those of you that want to know why is it that everyone projects that homeownership in the US will decline continuously over the next 3 decades, you can read any of these 3 reports. The one on the right, Myers and Lee, is my favorite. So it really explains homeownership trends and why we are seeing decline in homeownerships. And then below that is a lot of fun stuff. basically rankings, strongest housing markets, hottest housing markets, um, where to invest in housing in 2018. Basically, all kinds of ranking for single family and multifamily, and then all kinds of trends below that. So the first one is the impact of tax reform. The second one is inventory crisis. The third one is millennials. The fourth one is senior housing. The fifth one is rent control. Um, let's see, foreign investment is in there. So you've got a lot of different interesting trends that are impacting real estate, regardless of what it is that you're buying. All of those trends are in there. All of my webinars are in there. The show and tell, which you just looked at, and then a bunch of different webinars from me and other presenters, some rock star presenters in there. And lastly, for people that are into large multifamily, this link is incredible because it has city by city trends for multifamily for every city in the US, and it's free. Cap rates, rent growth, vacancy levels, incoming jobs, incoming companies, all of it sorted out by every city in the US. Obviously, it's only for multifamily guys, so I left it for the last. The whole toolkit is available to you. I want to make sure you guys get this URL correct. www.multifamilyu, and please don't forget the u.com/toolkit. So all you have to do is go in here, and the entire toolkit is available to you. Enjoy. Thank you for your trip to Planet Data. Back to you, Beau.
Anyways, that was awesome, and that's why I wanted you guys to see it. I suggest you guys go to the link, get the toolkit, study. I know we have Stephen Hatcher on here. He's a big apartment guy in North Carolina. I'm sure he enjoyed this, and some others on this call or webinar. But anyway.
Hello, Stephen. Let's talk.
Yeah. Anyways, I'm glad that you guys attended, and we're going to probably schedule an REI bar camp like we did, and hopefully we can get that on the calendar and get Neil invited to that. If you guys,
love that.
Yeah, because we always enjoy you there. Appreciate your time, and if you guys have any questions or anything, feel free to reach out to me, or I can put you in contact with Neil, or just go to his website, and I'm sure you can direct message him from there. Other than that, everybody have a great night, and we'll see you on the next one.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.